Xerox just admitted to faking $6 billion in sales. Not stealing money out of a vault, not a Ponzi scheme paying old investors with new cash. Executives at one of the most recognizable companies in America simply moved future revenue into today's books for years to make the numbers look better than they actually were. This is the story of Xerox. To understand how a company this famous ended up here, you have to go back to what Xerox actually was. For most of the 20th century, Xerox wasn't just a copier company, it was the Copier company. The brand was so dominant that Xeroxing became a verb, the way people said Googling decades later. Xerox invented the modern photocopier, built an enormous corporate research division, and for a long stretch of the century, it was one of the most innovative and profitable companies in America. But by the 1990s, that dominance was cracking. Japanese manufacturers like Canon, Ricoh, and Minolta had spent years building cheaper, increasingly reliable competing machines, and they were taking market share fast. At the same time, the entire industry was shifting. Digital printing and networked office equipment were starting to replace the standalone analog copier that had built Xerox's empire in the first place. Growth, which Wall Street had come to expect from Xerox almost as a birthright, was slowing down. Xerox's business model relied heavily on leasing. Companies didn't typically buy a copier outright. They leased the equipment over several years, often bundled together with servicing contracts and supplies. Under standard accounting rules, that kind of revenue is supposed to be recognized gradually, spread out over the life of the lease as the customer actually pays and uses the equipment, split between the equipment portion and the service portion of the contract. Xerox's finance executives found a way around that. Starting around 1997, under CFO Barry Romerill, and continuing through the tenure of CEO Paul Allaire, and later G. Richard Toman, Xerox began aggressively front-loading its lease revenue. Instead of recognizing the equipment portion of a lease gradually over its multi-year term, the company would book a large chunk of the total contract value immediately, treating it more like an upfront equipment sale than what it actually was, a service-heavy, multi-year lease. Internally, this practice reportedly became known by a blunt nickname, the whip, a reference to how it whipped future revenue forward into the current quarter whenever the numbers needed a boost. The effect was exactly what you'd expect from borrowing against the future. Every time this move got made, it pulled earnings from later years into the present, making that quarter's results look stronger, and setting up an even bigger hole to fill the following year. To keep beating expectations, the company had to lean on the technique again and again, digging the gap deeper each time. It's the same basic trap that undoes almost every accounting fraud eventually. The fix that solves this quarter's problem only makes next quarter's problem bigger. And the whip wasn't the only tool. Xerox was also accused of using other accounting maneuvers to smooth its results, including questionable adjustments tied to currency translation on its international operations and dipping into reserves from other parts of the business to plug earnings gaps and hit specific targets almost to the penny, quarter after quarter. Investigators later described a company culture where finance executives treated the quarterly earnings number less like a report of what happened and more like a target to be engineered. For a while it worked. Xerox kept posting numbers that satisfied Wall Street analysts, and the stock held up even as the underlying copier business faced real structural competitive pressure that the earnings reports were quietly papering over. But eventually, the cracks became too big to hide. By 2000, Xerox's stock had begun sliding as investors picked up on inconsistencies between the company's reported performance and its actual cash position. A company can report strong paper profits while its cash flow tells a very different story, and that gap is often one of the first signs something is wrong. The SEC opened a formal investigation into Xerox's revenue recognition practices. The scale of what investigators found was staggering. In 2002, after a lengthy investigation, Xerox agreed to restate its financial results. The company admitted to improperly accelerating approximately $6.1 billion in equipment revenue between 1997 and 2000, overstating pre-tax earnings by roughly $1.4 billion over that period. At the time, it was one of the largest revenue restatements in corporate history, a staggering admission from a company that, unlike some of the outright frauds in this series, was actually a real, functioning, profitable business underneath all of it. Xerox agreed to pay a $10 million civil penalty to settle the SEC's charges, without admitting or denying wrongdoing in the formal settlement. Though the SEC's complaint laid out the accounting violations in exhaustive detail. At the time, it was the largest fine the SEC had ever levied against a company specifically for accounting fraud, a record that stood out even in an era that was about to be dominated by Enron and WorldCom. The consequences didn't stop with the company. Several senior Xerox executives, including CFO Barry Rummerill and other members of the finance team, were separately charged by the SEC and paid personal penalties as part of related settlements. Some of the largest individual penalties ever assessed against corporate executives for accounting fraud at that point. Xerox's outside auditor, KPMG, also faced its own SEC enforcement action over its role in reviewing and signing off on the questionable practices for years, raising the same uncomfortable question that would come up again and again in this era. Where were the auditors supposed to catch this? Unlike some of the more dramatic collapses in this series, Xerox didn't go bankrupt. It didn't disappear overnight, and there was no single catastrophic day where the stock lost 90% of its value in an afternoon. The stock did take a serious hit, falling from the 60s to under $5 a share at its lowest point in 2001, wiping out the majority of its market value over that stretch. But the company survived. New leadership, most notably CEO Anne Mulcahy, who took over in 2001 right in the middle of the crisis, spent years rebuilding the company's accounting practices, cutting costs, and slowly restoring investor trust. It was a long, unglamorous recovery rather than a dramatic collapse, proof that even a fraud this large doesn't always end the company involved. That's actually what makes Xerox worth studying, separate from the flashier collapses. It wasn't a company built entirely on fiction, the way some of the frauds we've covered were. It was a real, historically dominant business that leaned on accounting tricks to paper over a slowdown it didn't want to admit to Wall Street, pulling tomorrow's revenue into today, quarter after quarter, until the gap between what the company was reporting and what was actually happening got too wide to hide any longer. It's a reminder that not every fraud ends in total collapse. Sometimes it just ends in a very expensive correction, a decade of rebuilding, and a permanent asterisk next to a name that used to be synonymous with trust. Everything I use to make videos like this, scripts, tools, more stories, linloopsoftware.com. Tomorrow, the bank that hid its losses in a fake reinsurance company for 30 years.